Okay, last week, Sunday, we began to look at complex group structures. I hope I'm audible enough.
Yes.
All right, we began to look at complex structures. And if I recall, I said it is not very different from the simple structures, those principles that you learned when we were doing simple structure, all of those concepts that we did, building blocks, all of them still are very relevant when we come to complex group. Now, what really differentiates the simple group from the complex group was simply the fact that when we were doing simple group, the relationship was as simple as this. You had a case where Pico just owned ESCO and there was an NCI. There was no multi-levels. It was very simple. One parent, one subsidiary. But when it comes to complex group, you have one parent and you could have multiple subsidiaries. Or you could have one parent who owns a subsidiary that owns another subsidiary, or who owns a subsidiary that is a parent to another subsidiary, meaning that we now have to calculate what was the effective interest. By logic, whether you calculate effectively, because I remember somebody was asking a question as to why we still went on to consolidate the sub-subsidiary, even though the effective interest was less than 50%. I think we had a case where parent owned subsidiary 80%. Subsidiary was a parent to another subsidiary where it had 60% controlling interest. We said the effective interest in this case will be 80% multiplied by 60%, and that would give us 48%. So in this scenario, the question was, why did we go ahead and still consolidate? It's simple. If this parent needed to consolidate S1, and S1 happens to be a parent to S2, meaning that S1 made equity investment in S2. Don't forget that when Pico acquired S1, Pico had right into the assets and liabilities of S1. And should that be the case, if S1 has made an investment, equity controlling investment in S2, then it means that Pico has right into whatever gains that S1 is going to make in S2. So therefore, if S1 is a parent to S2, then it becomes incumbent on Pico when it prepares a group consolidated financial statement to consolidate the book of S2 as well. So it's as simple and as logical as that. It does not matter that the effective interest rate is 48%. However, because the effective interest rate is 48%, we'll go ahead and use that as basis for calculation when we will be considering fair value of purchase consideration. We'll be using that when we'll be considering what share of the profit of S2 belongs to PICO. So it will be relevant in those instances. We will also need that because we'll be doing, rather than do the breakdown for what makes up NCI, I said immediately you calculate the effective interest rate of PICO, the balance percentage is everything that belongs to NCI. I know because it was the first time we were doing that, it looks sort of, in S2, NCI is greater than PICO, and yet we are going ahead to consolidate. The simple logic is what I have just explained. If PICO owns S1 and S1 owns S2, therefore, you can simply say that S2 is under the control of PICO because PICO owns the parent of S2. So it's like that. And you will notice that whenever profit is shared, if you have even in practical terms in real life, you will notice that when profit is shared, that bottom line is shared between parent and NCI. They don't say parent, they say owners of parents. Whether the parent has owner or not, they will say owners of parent, and then they will say NCI. Is this clear? I thought it is important to start the class by first of all explaining this. Is this clear to us? I'm waiting for
Yes,
response.
sir. Yes, sir.
All right, beautiful. Okay, so let's move on. Also, we said when this is the case, the primary thing to first of all know how to do is calculate the effective interest rate. And I kept saying something last week. I kept saying that when you have been able to, when you have been able to determine the effective interest rate of the parent in your calculation of the goodwill, let me just move to a solution. In your calculation of the goodwill, you would have considered only that portion for the parent. What you have here is the estimation of the NCI. When I say estimation, I mean the carrying amount of the NCI as at the day of acquisition. The cost of acquiring, cost of acquisition of SSCO for NCI has not come into the picture yet. The only cost you have here is the cost of the owners of the parent. The ESCO bought SSCO, paid 55,000. Meanwhile, PICO owns 80% of ESCO. So therefore, what we use as a consideration transferred for PICO was 80%. The remaining 20%, I kept emphasizing that you must never forget that that's 20% when you will be considering the value of NCI post-acquisition. You must never forget this cost of acquisition, meaning the remaining 20% of the 55,000 that ESCO paid to SSCO. You must never forget that because many times students will forget that, then they'll say financial position did not balance. It will not balance because you left out that 20%. Okay? Another thing that I asked you to note, you must never forget, it won't matter, don't pay too much. You can't pay as much attention to ESCO buying SSCO. What you want to consolidate is not ESCO acquiring SSCO. What you want to consolidate is the book of PICO. Every constituent member of this group that is owned by PICO is what you want to bring into the books. So therefore, you should rather pay attention to PICO's interest in SSCO. So in as much as PICO only has an interest in SSCO because it is the owner of ESCO, it does not mean that you will pay attention to ESCO buying SSCO. Okay, we left this scenario and then we now consider the scenario where PICO does not only have indirect. Indirect is this case where we have mentioned that PICO only has an interest in SSCO because they are owners of ESCO. We could also have a case where the parent has a direct interest in the subsidiary. Now, that interest may not be a controlling interest. It may not be a controlling interest, but they have both direct and indirect interest. The direct will be PICO buying the shares of the subsidiary. However, PICO may also have indirect because they are owners of the parent of the subsidiary. So that can also take place. We saw that in this, we saw that in this other example. To solve that problem, I think it was problem 3. It was problem 3 that we solved. Let me just take us there. I think it was this question. Okay, it was the third one. It was question 3, where we said PICO had both direct and indirect. Okay, somebody use the chat box. All right, okay. I didn't see that earlier. All right, okay. You will see here, PICO acquired 60%. PICO acquired 60% shares in ESCO. Now, the same PICO acquired 20% in SSCO. Meanwhile, ESCO acquired 60% of the shares in SSCO, meaning ESCO has a controlling interest in SSCO. All right, 60%. But PICO also has the same 60% over ESCO. Now, this is the indirect interest. 60% multiplied by 60%, giving 36%. However, they also bought 20% of the shares in SSCO. So this is not a big deal. It's not so much of a big deal. We dealt with it last week. You can always go back to the video and to the note as well. I said the note is explanatory enough if we take our time and look at it. So today or tonight, we're going to be looking at a case where business combination is achieved in stages, meaning that we could have a case where control or controlling interest is not achieved at once. Controlling interest is not achieved at once, which is, in fact, a very realistic condition. So most times or sometimes you could have a company that is already having what is called significant influence. Are you getting my point? Significant influence, meaning that a company has greater or equals to 20% shares in a company, but less than 50%. We'll call them an associate, right? Now, you may also have a case where a company only bought shares in the first instance, holding less than 20%. Say, for instance, maybe 10 or 15%. And over time, they decided to buy more shares. Let's say, for instance, a company owned 18%. And at a date, they decided to buy, or they were able to buy additional 35%. When I add this together, I get 53%. Now, 53% means they have now crossed 50% mark, and now the relationship has changed. So initially, they would have been accounting for this 18% equity using IFRS 9, all right? They would have done that using IFRS 9. They could have been doing fair value through POL or fair value through OCI, or even accounting for that investment using what is called amortized cost. But the day they acquired this 35% more and they crossed the 50% mark, the relationship has changed. They are now parents of that company. And going forward from that day, they will no longer account for it using IFRS 9. They are now expected to consolidate using the rules of IFRS 10 and IFRS 3. When this is the case, what do we do? How do we go about it? Also, in a case where you add significant influence, say you had a significant influence to the tune of 35%, you got additional 5%, then at some point you got additional maybe, let's say 10%. This accrues to 50%. From that day you got 50%, you now have controlling interest. You will no longer account for your investment in that company as associate investment. It will now be called a parent-subsidiary relationship. Therefore, the rules of IFRS 3 and IFRS 10 would now apply. So let's go into the details. Let's go into the details of what this suggests. The material says a parent company or an investor may acquire controlling interest in a subsidiary as a result of several successful share acquisitions. Rather than purchasing the shares all on the same day, like we have assumed in all of our previous solutions. They said this type of acquisition is called business combination achieved in stages, or you can call it piecemeal acquisition. You see, some of us who met before we started using IFRS, who, when we were in uni, you did the local standards. Some of us will be very familiar with this term called piecemeal acquisition. Okay, let's look at the different situations or different types that we may have. We may have a previously held equity, say 10%, with no significant influence that was accounted for under IFRS 9, and this could go up to over 50%, and at that point, we say you have controlling interest. Or we could have a case like I had earlier mentioned, where you held over 20%, which is associate investment, you would have been treating using IAS 28, doing what is called equity accounting. All right? Or we could have a case whereby you add controlling interest. The only thing is that you increased your interest, for instance, from 51% to 73%. Now, what does IFRS 3 say about this condition? We're going to do it together. I want you to pay attention every step of the way so that nothing is confusing to you when we start to solve questions. Okay? Now, this is it. I said, whenever a non-controlling interest, either a simple investment, look at what is marked in red, either it's a simple investment or investment in associates, become a controlling interest, what do? It says the previously held investment, whether it is simple or associate, is treated as though it was disposed at fair value and reacquired at fair value. Now, what this means is that we are going to have to do a calculation between the fair value of your previously held interest, previously held equity interest, all right? And then we are going to compare this with the carrying amount, of the previously held investment. The fair value, the current, let me put it there, the current fair value versus the carrying amount of your previously held equity. The difference between these two is going to give us the profit or loss on the recognition of your previously held equity. Meaning that we are going to solve as though you sold those equity interests you used to have. Say, for instance, you used to have 35% equity interest, and you bought, this is associate investment, right? And the cost of investment was 1 million. Now you have bought additional 25%, or let's say 20%. Now, when you bought additional 20%, let's say you bought that even at 1.2 million. Now, the day you bought additional 20% is the day you became a parent. You had controlling interest. All right? Now, what we are saying is this. This is the previously held investment. This previously held investment, we are going to calculate what is the now carrying amount of this 1 million. It cost us 1 million naira. Perhaps we have had additional profit share, associate share of profit, let's say to the tune of 250, meaning that your carrying amount is now 1.25 million. Your associate investment has a carrying amount of 1.25 million. Okay? We're going to compare that with the fair value of this 1 million. Now, let's say in a scenario where the fair value as of this date, when you bought 20%, they didn't give us the share price. We'll simply assume that if this is the fair value of this 1.2 million, then 35% will now be 35 all over 20 multiplied by 1.2 million. Whatever we get will now be the fair value of this 35%. Let's do that math. To do that math, you have you have 35 over 20 multiplied by 1.2 million. That will give you 2.1 million. Now, my profit or loss on derecognition will now be this 2.1 million minus 1,250,000. Whatever I get is going to be the profit on derecognition of this earlier 1.25 million. Is this clear? I want to find out if it is clear. Before I move forward, is this clear?
Sir, please can you come again with the last part? Like
Okay.
after we calculated the fair value.
Okay. I want to know what the problem is here. Is it the calculation that is the problem, or even the understanding of that concept?
No, I understand the concept. I just want to know this 2.1 million and the 1,250, what are we trying to get, like by calculating
Okay,
this two?
I'll clear on my drawings. Now I'll do it again. So what I'm saying is this: if we paid 20, if we paid for 20% additional, we paid 1.2 million. Are you getting it? Now, what we are saying is, we said according to the concept, we are going to calculate the fair value of the 35% that we previously held. All right.
I think you are far away from the mic. The audio is breaking.
Is that what everybody is experiencing?
Yes, sir.
Wow. How about now?
It's better now.
All right, good. So what I was saying is this. So you used to have, sorry. So you used to have 35%. All right. Okay, good. You used to have 35%. We need to calculate, what we need to do is to calculate what is the fair value of this 35%, all right? And then we'll now compare that with the carrying amount, the current carrying amount of this investment that is worth 35%. All right? I now said, if the historical cost of your investment was, let's say, 1 million, remember equity accounting for associate investment, if your share of profit up until that time was, say, 250 million, meaning the carrying amount of this equity investment or associate investment is now 1.250. I'll come here, I'll say carrying amount is, after the day I acquired additional shares, is 1,250,000. Good. Now, how do I calculate this fair value for the 35%? I'll simply say, if I paid a consideration of 1.2 million for 20%, how much
Sorry,
is the fair value?
the audio is really breaking up. It's going low and coming higher. Yeah.
Okay. How about now? Is it clear now?
Yeah, it's okay.
Okay, so this is what I was saying. If the carrying amount is 1,250,000, like I have calculated here, when we come here, I am asking myself, 1.2 million gave me 20%. This is the fair value for 20%. Then what is the fair value for 35%? Let's say this is X. You know what I'm going to do? I'll cross multiply, all right? You remember that math now? You cross multiply. So when you cross multiply, at the end of the day, what you're going to have is 0, let's say 0.2x equals 1.25 multiplied by 0.35. To get x, I will say 1.25 multiplied by 0.35 all over 0.2. At the end of the day, you will find out that if you work this out, 1,250,000 multiplied by 0.35 divided by 0.2, I will get 2,187,000. Okay, this 2,187,500 is what I'm going to use, and I'm going to deduct this 1.250. Whatever I have is going to be my profit on the recognition. Is this clear now?
Yes, sir. Thank you.
Okay. All right. We'll go into a more practical example very soon, but let's just go through the whole step because that's not the only thing. If I have, if I have bought new equity, all right, what is more likely to happen again is that when you acquire straight, you would calculate goodwill, right? And we always said that goodwill is the difference between when we add, first of all, the transfer consideration, the fair value of the purchase consideration, plus NCI. Then you minus the net assets acquired. What you have is the resultant goodwill on consolidation. All right? You remember what we would normally do? Very straight up. In this instance, how do we calculate the goodwill on consolidation? Because we still need to calculate the fair value of the consideration and then add NCI and then subtract the net asset acquired. Whatever is the difference is the goodwill on consolidation, all right? Now, in this instance, remember that we first of all, let's say for instance, we first of all add 25%. Then let's say for instance, let's say 35%. Then we now bought additional 20%. Sorry. Additionally now, we have 55%. Okay? NCI is 45%. What I will simply do is to use the fair value of the 20% I've just paid for, then the fair value of the 35% I previously held. I will calculate that fair value. Then I will now add NCI. When I add the NCI, I now have the fair value of all the net assets of the subsidiary. Then I'm going to deduct that from the net assets that we acquired as at the day of acquisition. Whatever I get will now be my goodwill. Okay? I may need to demonstrate this so that we can get it easily. But it's very simple. If you follow what was done here, we're going to get it. Look at what it did. Consideration that was transferred, fair value of previously equity interest, previously held equity interest, then your non-controlling interest. So you add these three together, what you now have is this that you have here, then take it away from the fair value of the net assets as at the day you got control. The resultant answer is the goodwill on consolidation. So we are still going to go ahead and calculate goodwill. And the only thing that is new here is the profit or loss on derecognition. Profit or loss on derecognition. Because you have to derecognize your investment that you previously held. You have to derecognize it, whether it was a simple investment or it was an associate investment. Okay, let's move on. All right, problem 1. Let's look at this together. Raj has a subsidiary, Meg, which it acquired in stages. The details of the acquisition are as follows. All right, we have the date of acquisition, how much holding was acquired at the various dates, the retained earnings at acquisition, and then we have the purchase consideration at those different dates when Raj made investment in equity interest of Meg. Okay, we're told that the share capital of Meg, that is the subsidiary now, has remained the same since incorporation as 600 million. The fair values of the net assets of Meg were the same as their carrying amount at the date of acquisition. What we have done here with this simple example is so that you don't have to do any fair value adjustment. Examination question will not go like this, but for ease, so that we can be able to first of all get the concept, we'll make this assumption in problem 1. Okay, let's move further. Sorry. We were told Raj did not have significant influence over Meg at any time before gaining control of Meg. Now, this is important. Why are they telling you this? They are saying it because they know you may see 20% and immediately feel that, okay, Raj would have treated our investment in Meg as an associate investment. So they are using this opportunity to tell you that Raj has been treating this equity investment in Meg using IFRS 9. So therefore, we would consider what is the cost. If it is cost, okay, let's move forward. I'll come back to explain that. The group policy is to measure non-controlling interest at its proportionate share of the fair value of the subsidiary's identifiable net assets. What are we required to do? Simple. Just calculate the goodwill on the acquisition of Meg that will appear in the consolidated statement of financial position at 31st December 2016. B, you are required to calculate the profit on the derecognition of any previously held equity investment. Now, before we go into solving this question, it just occurred to me to quickly explain this. Instructive to note. Instructive to note here. Raj did not have significant influence. So therefore, he was not accounting, Raj was not accounting for Meg using equity accounting. No. Raj must have been using one of these, amortized cost or fair value through P or L, or fair value through OCI. One of the three. But don't forget that we were told that the fair value of MEG, the equity of MEG, is the same thing as what you have in the books. And I said, this is hardly ever going to be the case. We are just making a simple assumption. So when I want to account for the cost for the investment of Raj in MEG, the one they previously had, this 20%, I am going to account for it as the cost of the acquisition. Don't worry, we'll come back to it. Let's first of all go ahead and do the goodwill. I feel like when we get into questions, maybe past questions and all of that, we'll see those technical bits, and it will be a better opportunity to make those explanations. But just note, for now, according to the question, they do not have significant influence. Now look at how we're going to solve. First of all, we go ahead and do the goodwill. First of all, go ahead and do the goodwill. Now, let's do this together. When they bought 50%, on which date? They bought 50%, additional 50% on 1st January 2015, all right? And what was paid was actually 960 million. So we'll say fair value of consideration on that day, consideration was 960 million. All right. Now, but what is the fair value of previously held? Fair value of previously held shares. What is the fair value of previously held shares? In this case, you wanted to say something? Somebody has their mic on mute. Okay, I'll just go on. In this case, I'll say, share we paid 960 for 50%. Therefore, the current fair value of this 20% should be 20 over 50 times 960 million. Or you may do the primary school mathematics that I did the other time, which is to say 50%, hold on, it should be to say, should be 50%, the fair value we paid for it is 960 million. Then what would we pay, or what would we have paid in this circumstance? What would we have paid for 20%? And I can represent that with X. If I cross multiply, this is 0.50x equals to 960 million times 0.20, okay? Therefore, X will equals 960 million times 0.20 divided by 0.50. All right? Now, this is the same thing as if you calculate, I think you get 384 million. 384 million. Is that correct?
Yes, sir.
Yeah. Correct.
So we get 384 million. And even if you did, so what you can, sorry, What you can establish from here is that if I have not been given the value, the market value, if they did not tell me the market value of the shares of the subsidiary, this is how I am going to work out my fair value of previously held shares. Number one. Number two, I want you to pay attention to, if you look at what I did here when I didn't have to do that primary school mathematics, all I said was, what is the previously held holding over the current purchased holding? And then I multiply that by the consideration we paid. It's very easy that way. It's the same thing I did the other time when I said 35% previously held, 20%, the one we just purchased, multiplied by the fair value. Anytime you do that, you're going to get your answer correctly. Okay. Now, away from that, the next thing will be, what then is the NCI? They told us, according to the question, that the group policy is to measure NCI at its proportionate share of the fair value of the subsidiary's identifiable net assets. Now, according to the question, we were told that the shares, they told us that the shares, the capital, share capital of MEG has remained 600 million. So when I come here, net assets acquired, I will have OSC, how much? 600 million. Then I'm going to have retained earnings as at the day that we bought 50% more, January 1st, 2015. The retained earnings as of that day was 900. Okay? Making how much? 1,500. So therefore, my NCI, let me erase this one. My NCI is now going to be, we bought 20% before, we added 50%. NCI is now 30%. 30% of what? 30% of 1.5. Okay? Now, if we calculate 30% of 1.5, what we get is 500, if I'm correct. All right? Is it 500? Doesn't look like 500 times 30%, 450 rather. Okay? What we get is 450. So that 450, add it to 384 plus 384 plus 960, you get 1794. 1794 minus 15, you get 294. So the goodwill on consolidation will be 294. All right? Is this clear? Is this clear? How we got this goodwill? Is it clear? Please respond though, so I can know whether to move on. Is it clear?
Please take the NCI part again.
Yes. It is not clear.
Yes.
Okay. Let me take you straight to the solution. How did they get this 1.5? Don't forget, it's the same. I have told you the principle you learned for simple consolidation, you don't throw them away. One of the principles we learned was that NCI, the examiner will always tell us, how it is to be measured. Examiner told us here, they said, non-controlling interest is to be measured at the proportionate share of the fair value of the identifiable net asset of the subsidiary. Okay? What that means is this. The first thing I want to ask, if they say proportionate share, I will say, what is NCI percentage? All right? Multiplied by the net assets acquired at acquisition. All right? NCI percentage multiplied by net assets acquired at acquisition. So the question really is, what is the percentage of NCI? It's easy. We bought impeachment 20% first, then we bought additional 50%, meaning our holdings as of the day of acquisition is 70%. Very easy. The remaining 30%, 100 minus 70% equals 30%. So NCI is now 30%. But what is the net asset acquired? Very simple. They told us the ordinary share capital of MEG has remained 600 million even before we acquired it, and it has remained like that. However, as at the day of acquisition, the day of acquisition is the day we bought this additional 50%. What was the retained earnings? We were told that the retained earnings was 900 million, meaning that the net asset acquired is 1.5 billion. Are you there? Are you there? So if I take 1,500 million here and I do 30% of it, I am going to get 450. That's how we got this 450. Is it clear now?
Yes.
All right. Also, how we got the fair value of previously held shares. I want to believe that is also clear. So with this, we have dealt with one of the two problems that they asked us to solve. The second question they asked us to solve is a quite simpler one, very easy and straightforward. They asked us to calculate the fair value of the previously held equity interest. They asked us to calculate, the profit on the derecognition of any previously held equity investment. And I told you the other time, I said, to do this one, just ask yourself, what is the fair value of this current, the current fair value of this previously held equity investment? What is the current fair value? We just calculated it now. We got 384 when we calculated it. The question will now be, what was the cost or carrying amount of the investment? Now, what we are referring to here is the 20% that we previously had. We said the fair value is 384 million. However, when we bought those 20% shares, what was the amount that we paid?
240.
How much did you call it?
240.
240. All right. What is the difference you have here? It looks like 144 to me.
Yeah,
this
correct.
will be the profit. Okay. Let's go to the solution. You see that that's the same thing that must have been done there. 144. Is this clear? This one is easy. Is this clear?
Yes, clear.
All right. Okay. Let's go to problem 2 then, if it is clear. Okay, before I move on, I just wanted to know, it is instructive that what we are referring to here is the initial 20%. It has nothing to do with the new 50% that we have just bought. Let's go to problem 2. Problem 2, we are told Mammon acquired 25% of Regis. 1 second. Mammon acquired 25% of Regis on January 1st, 2014 for 1,010,000 and exercised significant influence. I repeat, exercised significant influence over the financial and operating policy decisions of Regis. The fair value of Regis identifiable assets and liabilities at that date was equivalent to their book value, and Regis reserve stood at 2.9 million. If I were you in the exam hall, I would want to take, because you see, when the information gets plenty or is many like that, you may lose track. So what you should do, or what I will advise you to do, is this. For each paragraph, pick out what is the necessary information you need. If I were you, I would say holding as at this date is 25%. Which date? January 1st, 20. Okay. How much did we pay? The cost was 1,010,000. Okay. What was the reserve of Regis at acquisition date? At acquisition date, reserves was 2.9 million. You see, what I have done by doing this shorthand is all the necessary information in the first paragraph, I have shorthanded it that way. It will be impossible for me to get lost in the midst of all the information. Let's move to the second paragraph. We're told a further 35% equity interest in Regis was acquired on 30th September 2016 for 2.1 million. They said we paid a premium over Regis market share price to achieve control. Is it true that we achieved control? Absolutely yes. Is it true that we achieved control? Absolutely yes. How did I know that? We used to previously have 25%. We have acquired a further 30%, 35% rather. If I add that together, I get 60%. All right? Now, that 60% means we now have an effective controlling interest. All right? But here we are told we paid a premium over Regis market share price to achieve control. And it's just a way of telling me that I should pay attention. There might be some fair value adjustment. Okay? Now, the fair value of Regis identifiable assets and liabilities at that day was 4.6 million. The fair value was 4.6 million. But the Regis reserve stood at 3.9 million. We're going to come back to this because they made me know that we paid a premium over Regis market share price. indication will tell me that they are likely going to tell me what is going to account for that premium. Why did we pay a premium? Okay. It's indicative that we may have fair value adjustment. So I'm just going to keep that in mind. So I will say, yeah, 30th September, we now have our holding to be how much? 60%, but we acquired additional 35%. Okay. What was the consideration or cost of this investment? It was 2.1 million. All right. And now we have been told fair value of acquired assets is equal to fair value of net assets acquired is equals to 4.6 million. However, reserve is 3.9 million. I have not started solving. I'm just trying to let you see how you can do like a shorthand whilst in the exam, or so that you don't lose track of what you are doing. Okay? Away from all of this, like I said, I've not started solving. I'm just reading the question and trying to understand it as well. We were told Regi's share price as of 30th September 2016 was 15 naira. As at the day of acquisition, 15 naira. I already told you, whenever they give you this share price at the day of acquisition, even if they did not mention it to you, you should know that you are going to measure NCI.
That line is break.
My voice is breaking, Ke. How about now? Is it better now?
It's
Yes,
better,
sir.
it's better.
It's okay.
All right. So what this means, they have given me share price of the subsidiary. It means the policy is most likely, except they tell me otherwise. If they don't tell me otherwise and they even keep quiet, I shouldn't bother myself. I am going to measure NCI at the full or fair value. That's what it means. Okay. Let's quickly look at the statement of financial position of these two companies. Okay. It gave us as at 31st December 2016. Now, what this also means to me, 3 days I must keep in mind, when we got the initial 25%, it was 1 second. When we got the initial one, it was, I think, January 1st, 2014. Then the day we had control is 30th September 2016. This is the day it became incumbent on Mammon to begin to consolidate, right? However, the statement of financial position is this date, 31st December 2016. I already begin to have an idea. This is going to be my consolidation date. This is going to be my acquisition date. Even though we acquired in piecemeal, what I will recognize as my acquisition date is the day I got control, which is 30th September 2016. Okay, move on from that. All right. Then we were also given the summarized statement of profit or loss and OCI for the year 31st December 2016. Given that, all right, that is another information that we've not had to work with this whole time. We focused on statement of financial position, but now we have been given the statement of profit or loss for the two companies. Let's move on. The difference between the fair value, please pay attention here. The difference between the fair value of the identifiable assets and liabilities of Regis and their carrying amount relates to Regis brand. Okay. Now, I said the other time that when they mentioned here, when they mentioned here, second paragraph, that we paid a premium over Reggie's market share price. It means we are going to likely have fair value adjustment because this market price is a fair value on its own. Do you agree with me? The market share price is a fair value. I ought to have paid 15 naira multiplied by the number of shares that I acquired. If I am paying anything additional above that, it means that we have had a reassessment of the assets and liabilities of Regis, and then we came to a conclusion that we need to make a fair value adjustment. Now, what is that fair value adjustment is what they have just mentioned to you in a nutshell. Immediately I see this, my mind should go to that one they told me. This is why we had to pay extra. Is this clear? The reason we have to pay extra is we were paying for Reggie's brand. Now, this occurs in business combination. Do you want to buy this company? Oh, market price is 15 naira. Before we go ahead in that M&A, what would be done is to consider all the assets and all the liabilities of that company. And all of them will be fair value. Do you understand now? So things like brand that would not, I mentioned it previously when I discussed goodwill with you. Now, how come we have goodwill that would not have shown in the separate financials of either the parent or the subsidiary? And one thing we said, or that I mentioned to you, was the fact that in as much as we would not have brought it in that instance for goodwill, when you do business combination, acquisition, goodwill will now qualify. Why? Because we have proven that someone could pay for that goodwill in a separate transaction. That is, that goodwill, you say it has a value. How we know it has a value, what will prove to us that it has a value is that somebody must be willing, or somebody has shown that they are going to pay for it. Okay? And that is when you get to, I don't know if you've done IAS 38 with Mr. Wasil, I'm sure he's going to delve into this, why it has to be that in a separate, because if care is not taken, every company will just say we have brand, we have goodwill, all those intangible assets, you just see them there. And meanwhile, nobody is willing to pay even 1 naira for that asset. So why should it be in your books, okay? But now, in this case, this brand needs to be consolidated. And we're going to see how it is going to be done when we get to solution. However, we're told that the brands were estimated to have an average remaining useful life of 5 years from 30th September 2016. It means that you're going to have to calculate yearly amortization or depreciation for this brand, okay? But we don't know the value of the brand yet. However, we have been told how we are going to calculate it. It's simple. It is going to be the difference between the fair value of the asset and liabilities of Regis and their carrying amount. We'll do it. Income and expenses are assumed to accrue evenly over the year. Mammon policy is to measure non-controlling interest at the date of acquisition at fair value. I have said, even if the question was quiet here, you have given me share price, it means it is possible for me to calculate fair value. I will go for this method. You don't need to tell me. I already know that's what I'm going to do. But the examiner will always tell you anyway. What are we required to do? We're required to prepare the consolidated statement of financial position as at December 31st, 2016, and the consolidated statement of profit or loss and other comprehensive income of Mammon Group for the year ended 31st December 2016. Okay, let's look at how this was done. Okay, what I was asking you to shorthand the other time is what they have done here for you. We'll look at it together. The date that we bought 25%, the cost of investment was this. This was the reserve, okay? Cost of investment, 30th September, when we got control, we bought additional 35%. This was the cost of our investment. This was the carrying amount of the reserves as of that day. All right. So the group structure is clear to us. It's as good as a simple consolidation. The only difference is this: we have acquisition in piecemeal. It is not even a complex structure. It's just a matter of acquisition was made in piecemeal. And the first rule or the first principle that we must pay attention to here is that we need to calculate goodwill. And how we are going to calculate goodwill is by, I said, you're going to add the transfer consideration for the newly acquired equity plus the fair value of the previously held equities. Then you now have NCI, all right? But don't forget, you have been told that NCI is to be valued at fair value, okay? Now let's go. This timeline is very important. Now, at the beginning of the question, they told us that that 25% was accounted for using associate investment, equity accounting, all right? Okay. Let us quickly look at this analysis, very important to us. This is the day they had control. From this day going forward, consolidate. But from this date, when we began the year, up until this date, in fact, from 2014, up until this date, we would have been doing equity accounting. And what that really means is that we only just take a share in the of the of the subsidiary. And whenever we want to account for our investment, we will say the carrying amount of our investment will be the cost plus our share of the profits of the subsidiary. So when I want to account for the carrying amount of the previously held equities, this is what I'm going to do. I didn't do this in the first example because we're specifically told that even though they had 20% in that question, they did not have significant influence. But this one, they told us they have significant influence. So therefore, equity accounting means that the carrying amount of our investment should be the cost plus our share of the profits of the subsidiary. Okay? But let's go into the calculation of goodwill now. I think it's easy now from here. How do we calculate goodwill? Okay, consideration, 2.1 million, isn't it? Now, the previously held investment came at a cost of 1,010,000. By this, I am only referring to the historical cost. I said, as a matter of fact, for us to calculate the carrying amount, I still need to add profits. But that's not what I need here. What I need when I want to calculate goodwill is the fair value, the current fair value of this previously held investment. So the question will be, what is the previously held investment? We add 25% of the total shares of the subsidiary. How do we know the shares of the subsidiary? We can always go back to the question. The question told us, when you come to the financial statement of financial position, you will see here, this company had 400,000 as their share capital. And this share capital is at 1 naira book value, 1 naira per share, meaning that all the number of shares they had must have been 400,000 divided by 1 naira, and that's 400,000 shares. Okay, so when I want to calculate the fair value, the current fair value of the 25% that we currently hold, I would just say 25% multiplied by 400,000 shares multiplied by 15 naira. And that's how they got this 1.5. Okay, now for me to calculate NCI, I have been told every time you want to measure NCI, you ask yourself, what is the policy? The policy is fair value. Okay, no problem. 40%. How do I know it's 40%? Very simple. This fair value consideration was made for an additional 35%. This is 25%, making 60. Therefore, what is left is 40%. 40% of this 400,000 shares multiplied by 15 naira. That gives me this 2.4 million. Is this clear? Is this clear? I'm asking, is this clear?
Yes, sir.
Thank you. Now, we have done, you can see that we have calculated 100% that way. I have done the breakdown. It's 35% additional for the consideration, 25% for previously held investment, and NCI is 40%. Good. When I total, the next thing will be, what is the net asset that we acquired at the day of control? Now, ordinary share capital is 400. Retained earnings is 3,900. But don't even worry about all of this. They already told you that the fair value of the net asset acquired was 4.6 million. This 4.6 million. And they told us that the difference between the carrying amount and this fair value is actually accounted for as brands. I don't know if you recall. Let me quickly take us back a little bit to the question. They mentioned it. They said in the second paragraph, they said that, look at the last statement, the fair value of Regis identifiable assets and liabilities at that date was 4.6 million. They told me the fair value of the net asset at this point. They only now went further to tell me that the reserve stood at 3.9. Now, if you add that reserve to the ordinary share capital of 400,000, what you get is 4.3 million. What you get is 4.3 million. Now that 4.3 million is the carrying amount. 4.6, they said, is the fair value. Now, the difference, they said, is brand. So how do I account for this brand of 300,000? And I'm going to use it to cancel out this 100%. All right. And then it will now make its way into the consolidated statement of financial position. All right. I will use it to cancel out the purchase consideration and NCI. Okay. To get my goodwill, I will do that first of all. Then it will now make its way into the consolidated financial position as an asset. However, they told me that the useful life of this brand is going to be for 5 years. It's going to be for 5 years, meaning that it will have a yearly amortization. A yearly amortization of 300,000 divided by 5, which is equal to 60,000 per annum. All right. But don't forget that I want to carry this brand into my consolidated statement of financial position. But my consolidation did not start from the beginning of the year. I am consolidating as at 31st December, but my consolidation, yes, should begin from 30th September. Now, if I count from 30th September to 31st December, I can't count September because it is the last date in September. So therefore, I'll start from October, November, and December. That's for 3 months. So if 60,000 is yearly, that will be for 12 months. 3 months now will be 3/12 times 60,000. Meaning that in my statement of profit or loss, I am going to add this as part of the amortization or depreciation. And that will be 50,000. Okay. So what I will do to this 15,000 is this. I will say this 15,000 in my statement of financial position, this 15,000 should go to P or L. Like I always say, what represents my P or L in my statement of financial position is the consolidated retained earnings. So my consolidated retained earnings would carry this additional expense of 15,000. While I am going to reduce my assets. Which asset now? Brand. I will reduce it by 15,000. What will show in my consolidated statement of financial position is not 300,000. Rather, what will show will be 300,000 minus 15,000 equals 285,000. Is this clear? Is this clear? Should I call names? Abidemi Akonde, is this clear? Praise Koyejo, is this clear? Ogenetega, is this clear? Lukman, is this clear? Mercy, I want you to respond if it is clear or not. It's quite straightforward though, but is it clear?
Yes, it's clear.
Mercy says it's clear. I want to believe she speaks for everybody. It's simple, it's straightforward.
It's okay.
All right, thank you, Lukman. So let's go back. So that explains how they got the goodwill, right? That explains how we derived the brand. And it also explains why we are having additional depreciation, but we had to prorate for 3 months. And then we had to credit brand. Instead of 300,000, it's going to come up as 285,000. Now let's go to, I don't want us to jump to consolidated retained earnings. I want us to first of all do, because we must not forget, anytime it is piecemeal acquisition, you are going to have to calculate profit or loss on derecognition. So straightforward. We have seen now, we calculated the fair value. Permit me to go back a little bit. Okay, we calculated fair value of previously held equity investment, and it was 1.5 million. Abi? Okay, good. 1.5 million. That's the current fair value. Now, how about what is the carrying amount? What is the carrying amount of our investment? Okay. Now, the day that we are derecognizing is 30th September, isn't it? We are derecognizing 30th September. 1 second, please. We are recognizing 30th, we are derecognizing that previously held investment 30th September. All right. So the question will now be, what is the carrying amount? We were told historical value is how much? 1,010. All right. We were told it is 1,010. And then we were also told that as of the day we are to derecognize, as of the day that we are to derecognize, it had sorry, please. 1 second. Let me go back. Okay, we were told 30th September, they had reserves 3.9 million. Okay. But don't you forget, please pay attention to this explanation I want to give. Don't you forget that when we bought this 25%, the reserve stood at 2.9 million. Are we together? Meaning that Mammon would never have had a share in this 2.9 million. All right? But any profit that Regis makes from that day, Mammon will have their share, 25% of the profit. Okay? But as at the day we want to derecognize, the day we bought further shares, reserve is now 3.9 million, meaning that from this day, they have made additional profit of how much? 3.9 million minus 2.9 million, meaning they have generated additional 1 million naira profit. Is this clear?
Yes.
Very good. So the share of profit will be 25% of 1,000. And that should give us how much? It should give us 250. Meaning the carrying amount is 1,260. So I will say current fair value is 1.5 million. All right. Current fair value is 1.5 million. All right. Carrying amount is going to be the cost of investment plus 25% of the post acquired profit. We acquired 25%. What were the profits that was made afterwards until the day that we are derecognizing? Okay, and we've calculated that. So this is how they got 240. Is this clear? All right, I want to believe it is clear. So we move forward. So now I know, because the reason I had to quickly do this calculation, although in the solution, the first thing they did was consolidated retained earnings. I don't want you to follow that pattern. And the reason I don't want you to follow that pattern is you may forget. You will just forget that they have, the parent have a profit on the recognition. When you are consolidating, if you leave that out, your financial position will not balance. All right. Okay, so we have seen how goodwill is calculated. We have seen how to treat the fair value adjustment of brand. And we now know how it is even going to impact our statement of profit or loss. And now we've also looked at profit or loss on derecognition. Now we can consolidate our reserves. Okay, very easy the way we used to do it before. The only thing is, we'll now look at it like this. This is the post acquisition profit up until the date we stopped recognizing Regis as an associate investment. Okay. Now, when we now got controlling interest, it is 39. But currently, when you go and look at your financial position as of the date of consolidation, 31st December 2016, I'm sure if you look at your question, you see 3.95 million as the retained earnings or reserves. All right? Meaning that between 30th September to 31st December, all that came into the books as profit was only an additional 50. So what do we do? Now, don't forget that we said this additional depreciation, we will debit retained earnings. Okay? Now, and then we said we're going to credit brand. Now, I also told you one secret about this. I said, when your fair value adjustment is going to be shared between NCI and parent, it is under subsidiary like this that I'm going to do my adjustment. Had it been that this 15,000 is a loss or an expense that is solely to the parent, we won't do it here. We'll come and put it here. In fact, let me put it on that line. It will be here. Meaning that it is only mammon. But let's make sense of it. If there is brand and we have to do an adjustment and it belongs to the subsidiary, it does not sound to me like a transaction that affects only the parent. So that is why that 15 is there. Okay. So meaning that the adjusted post-acquisition retained earnings is 35. All right. And then this, what is it called? 240. I think this is a mistake. This one should be here. This 40 belongs solely to the parent. It belongs solely to Mammon. All right. It belongs solely to Mammon. It shouldn't be here. It should not be here. No. It should be only be here. Okay. Now, we're still going to go ahead and calculate what is the shares. What is the share of post 25% acquisition? What is the post, what is it called? Post-acquisition share of profit. It is 1,000, everything. Will take only 25%. That will go to the parent. What is left after we now got controlling interest is 35. From that, we are going to take the total 60% because we now have 60%, and that's how they got 21. But if you notice very well, if you add 19,960 plus 240 plus 250 plus 21, that is when you are going to get 20,471. Is that not the case? Is that not the case? I'm sure that is the case.
Yes, sir, that's the case.
All right. Okay. Now, I want to finish business with SOPL first. All right. I want to finish business with SOPL first. But what they have done here for NCI, so if you look at your statement of profit or loss, you will see that there is other comprehensive income. All right. So the way we are going to share the profit, we'll look at what is NCI share of the profit for the year and what is NCI share of the OCI. All right. And it is that calculation that was done as the last working that you have here. Okay. So profit for the year is PFI, OCI, of course, is other comprehensive income. All right. Like I said earlier, this 15 affects both of them. Okay. So even though the question had told you the profit was 40 and OCI was 50, you take out the expense, the new expense, which is your additional depreciation. What is left here is what NCI is going to get as its own share of profit. They get 10 for profit for the year. They get 14 for OCI. All right. Now let's quickly look at what the consolidated statement of financial position looks like. All right. Our PPE will simply consolidate straight. We're not giving any additional information that affected this. So we simply consolidate by adding, simply consolidate by adding this. However, this investment in Regis is the addition of the 1,010 plus 2,100. If you add it together, of course, that's what Mammon would have done in their separate book. But we are going to cancel out this And in canceling it out, we would have goodwill of 1,400 that we calculated earlier. And then we're going to have brand of 285 after adjusting for additional, depreciation. The current assets will just be added straight, okay? That would have dealt with everything on the asset side. Let's look at it. So that's what you have here, like I mentioned earlier. However, this one is straightforward. Share capital of the subsidiary has been cancelled out. So it's only the share capital of the parent you are going to see. The reserve, consolidated reserve, we saw how that was done, okay? Now, pay attention to non-controlling interest because they are referencing working 6. But the only thing you saw in working 6 was what was going to be NCI share of profit for the year, Abi, and OCI, Abi. All right. Now, if you go to the workings, we did NCI here. And NCI was valued at 2,400. 2,400. You will now recall that out of the 40, that was the profit for the year, according to the profit or loss statement, 40 Abi, and according to the OCI, we had 50 revaluation gain. We take out 15,000. We got 25 here, we got 35 here. They got 40% of this each. Abi, meaning they got 10 naira here, and then they got what is 0.4 times 35. They got 14 there. They got 14 here, and that makes 24. All right. Now, that was how they got that 24. That 24, you're simply adding it to the fair value of their investment. That's how they got 2,424 as the NCI. All right. Okay, so you simply add up your liabilities. That is how we came about the statement of consolidated statement of financial position. For your profit or loss is quite straightforward. All I'm going to do, the only thing that is extra here, I have said, if you are confused, don't be confused, follow the timeline. The day you start consolidating is the day that you gained control. What day did we gain control? We gained control 30th September. I said, you can't count September. Why? Because you gain it at the end of September. So you count October, November, December, 3 months. So all of the revenue, incomes and expenses of regis that you were given in their separate statement of profit or loss, you are only going to apportion for 3 months. I don't know, I think when we were doing the building blocks for simple consolidation, I don't remember, but one of the exercise there was acquisition during the year. It's quite simple and straightforward. All your P&L items, you will only begin from the day in between the year that you acquired. You count down to the end of that financial year. How many months do you have? You start to apportion both the revenue and expenses that way. That's what they did there. So it's not a big deal. So that's why I'm saying 3/12. But don't forget, that we did an adjustment, and that's that 15 that they brought in here. Okay, and then also there is a profit on the recognition that belongs to the parent. Also, we only began to consolidate 30th September. We were an associate previously. So therefore, the share of profit as an associate for those 9 months from January 1 to 30th September will also come into the books. So meaning that let's go to the separate. I want to see where this got the 160 from. The profit for the year that Regis had, you're going to take what you would have collected as a, what is it called now? As an associate investor. And that is how we will look at that all through. So this is quite clear, quite simple. How do you do right from simple consolidation in FR? What you do in this sharing, whatever you have had as your calculation for NCI, the balance of it is what is going to the owners of the parent. The only third party we are paying share of profit to, or we owe share of profit to, is the NCI. Whatever is left belongs to owner of parent. Now, that explains the owners of parent I was trying to explain at the beginning of the class when I said, even if effective interest rate is lower than 50%, we'll still go ahead and consolidate, okay? So that explains why they normally say owners of parent, okay? We'll just look at this and then we'll round it up here when a case when you have, we'll continue from disposal of equity interest in the next class. We'll round up with increase in controlling interest. If you recall, we said that there are 3 scenarios. There are 3 scenarios in business combination achieved in stages. There are 3 scenarios we pointed out. Let me just quickly take you there so that you will recall. Although I made more explanation around these first 2 that we have looked at, but there is a third one. You may not have paid so much attention to it. Let me quickly remind you. You see, we could have had a simple investment. Okay? You see, there are 3 scenarios here. A simple investment to parent, equity investment to becoming parent. But what if we are already a parent? We had already achieved controlling interest when we had 51%. All right? But then we still went ahead to acquire more equity to the tune where we now have 73, meaning we had acquired additional 22%. So how do you treat this? Okay. What we have done has been focused on a case where we were not parent initially. And this one is quite straightforward. Let's look at it. They said we have critically looked at how to prepare consolidated financial statements when it is equity or investment in equity with significant influence or simple investment. All right. When you increase your controlling interest, it will be treated as transaction between owners, meaning that there is a reallocation of ownership interest between parents and non-controlling interest. What are we saying here? You add 51% parents, all right? NCI, how many percent? 49%. If you then now have 73%, it can only mean one thing. Out of the shares that used to belong to NCI, you got 22 additional shares from them. So this transaction is between parents and NCI, meaning now that NCI will now be only 27%. Because if you take 22% out of 49, what you have left is 27%. Okay? And they're giving us a simple scenario. They said, if a parent has, I'm reading from the second paragraph, they said if a parent has 70% equity interest in a subsidiary, which makes the non-controlling interest at 30%. If the parent should increase its holding by 8%, which brings its holding to 78%, and reduces NCI to 22%, this implies that NCI sold 8% of its holding to the parent, hence a transaction between owners. Okay? I want to believe that is straightforward. Okay? Sorry, 1 second, please. Okay. Now, accordingly, the parent is adjusted as follows. Adjustment to parent equity will be, we're going to consider what is the fair value of consideration that was paid. And then we're going to consider the decrease in NCI, in net assets as at that day. What you have is the increase in controlling interest. Let's look at a very simple example here. Okay, the facts are the same as in question 1. Let me see the question 1 they are referring to. Okay, the question we just looked at is what they are referring to. Sorry. They now said, show the consolidated current assets, non-controlling interest, and reserves figure if Mammon acquired additional 10% interest in Regis on 31st December 2017. All right. Okay. They paid 700,000 for 10%. Okay. Now, the implication of that is simple. They used to have 60%. Now they are going to have 70%, all right? Because they bought additional 10%. And the implication again is that NCI will now reduce from 40% to 30%. Like I said, to calculate the increase in control, what is the consideration that was paid? 700,000. Now, what is the decrease in NCI? Sorry. Now, 40% used to equal this. This is the carrying amount, okay? Then, what does 10% represent in this instance? If I cross multiply, I'll come to a point where I'm going to have 10% over 40% times 2414. If I do 2414 divided by, divided by 4, I get 603 0.5. Now, this difference between the consideration that was paid and the carrying amount, what is the proportionate share of what they lost or what they have sold? This is what is going to represent the, sorry. So how do we account for this? How do we account for this? Your non-controlling interest will reduce. Don't forget, one of the things that we must keep reminding ourselves is that NCI is a component, is an equity component. Because it's an investment, you may want to say, oh, assets. In your group account, in your consolidated financial statement, you were always putting it under equity. You must put it as such. Yeah, in the book of the NCI, they may regard it as assets, but in consolidated financial position, we'll refer to it as a component of equity. So therefore, any reduction in equity should be a debit. All right? This payment is this 700. Now, this difference is going to be a debit to profit or loss. You know why? In your consolidated financial statement, you are going to recognize this 96.5 as a loss because you have paid higher than the current carrying amount of the NCI you bought. You bought 10% of NCI, all right? Now that 10%, when we calculated it, it was equivalent to this. But what you paid was higher than it. That will be treated as a loss on that transaction, and you will take that to your SOP or your consolidated SOP. Also, as per our previous solution, our current asset was 7,450. You have paid cash now. Cash has reduced by 700, meaning that your current assets will also reduced by that 700. Of course, your NCI, you have sold 10%. NCI have sold 10% to parent. It should also reduce by the carrying amount of that NCI, which was 603,500. I don't need to explain consolidated reserve. If it is going to affect, if that 96.5 is going to SPO, you should know definitely to be represented on your statement of financial position under reserves. All right. So this is where we're going to draw the curtain for tonight. Next week, we're going to look at disposal of equity interest. We'll soon be done. If you look at the number of pages, we are on page 330. We'll be on page 338. In the next class, we may be able to round up on this building of blocks that we've been doing. We still have one or two major critical things to look at. Things like foreign subsidiary and the likes, cash flow as well. I think after this topic, I'll just enter cash flow. But then before we even do that, we'll need to look at proper examination questions. But the blocks we are building, I want to be sure that we are getting it, that we're understanding it. That is the most important thing for me. All right? Okay. So the question, Praise, Lukman, any questions?